Just he traces the ID, Kevin I
can oversee.
That was a dumb question.
It's like, no, I do it. I usually just notice and get going.
Hi, we're live.
We'll do this at the end. All right, welcome to the second AIM presentation of fall 2022. We have 6 victims available today that will start us off in a particular order. For those following at home, if you can't access the write-ups, please make sure you get on the links and those sorts of things. But given that you're seeing this, you probably got to do that. So in no particular order, we're going to start with Michael O'Donnell and Applied Industrial Technologies. And even though our format is changing, although it looks like our first one looks very familiar, over time we're going to see these formats change. We're still the tried and true AIM. We're going to have a few more appendices over time. You'll see those things. And I'd prefer we start off with a little bit of our norm until Dr. Valentine corrects me, which is tell us how you found this company. I'd like to know about your screening process at a real quick basic level. And if there are 1 or 2 questions posed online you feel you didn't get to answer or didn't answer thoroughly, let's start with that, and then we'll open the floor to Q&A. Work for everybody? So, Michael, where are you?
Right
in front of my face. There we go. Take us away.
Dr. Valentine, then I'll shut my laptop, so I'm not distracting you guys. You can watch this. At the end of it, to look for a short presentation.
Yeah, so my name is Michael O'Donnell. I'm a senior in the Applied Investment Management program. And today I'll be pitching Applied Industrial Technologies with a price target of $117, representing 19% upside. So kind of just to go into my screening process, I was really looking for a company that had some sort of recurring revenue base. It was something that I spent a lot of time over this summer looking at companies that kind of embodied this business model. I was looking for low leverage as well, just considering kind of the rising rate environment, and then kind of just a low beta because I knew my margins probably wouldn't be growing as aggressively as they had in the past. So if I wasn't growing my bottom line as fast, I knew if I was going to discount those cash flows back, I should probably have a low cost of equity. So one question I received a lot of in the D2O discussion was, I believe it's my first risk about LIFO accounting. So LIFO accounting, when you have times of rising costs, your cost of goods sold go up since your inventory is recorded at cost and you're taking your last in is now your first out. So if you look at my peers, they really vary on what they use. Some use FIFO, some use weighted average cost, and then a couple use LIFO. So I think just the way I look at that risk is they've kind of been able to go through this, so their gross margin stays around 29%. So LIFO had a negative impact of 72 basis points for this fiscal year, but they still stayed on that 29% gross margin. So with that, I will open the floor.
So questions from the crowd. First is Basil. Raise your hand, I'll keep track.
Can you please talk about your company's level of debt and what they're actually doing to combat that during this rough time?
Yeah, so if you look about 2 years back, their net debt to EBITDA, and that's adjusted EBITDA, was 2.7 times, and now they're at the 1.2 times area. So most of their debt is fixed. The only area that's not fixed is the revolver, which is due in 2026. And they have about 410. They've drawn on 410 million of that, and that's LIBOR plus 80 to 155 basis points. But again, I think it's pretty modest when you look at kind of the broader scale of things. So,
Thank you.
That's great. No one else had their hand up. That means I get to ask questions that I always get excited about. So help me understand, is MSC Industrial direct to good comp?
Yeah, so I guess the hard part about finding companies was just
Well, I'm not criticizing it.
Yeah.
You included it, so I assume you like it.
Yeah,
So why aren't we being pitched it? I mean, I look at it, I got a lower PE, a lower EV to EBITDA, a lower price to book, about the same retained. I got better margins.
Yeah.
Like, why are we airing this one?
So I actually looked at pitching MSC. So two of the companies I looked at, EnerSys, which Andrew Payne is doing, and then MSC. The thing with MSC is their margins are consistently going down. And then in my recommendation, I talk about how Amazon has kind of the onset of Amazon with their product offerings just are really boundless. So you have companies like MSC just adding these really high turnover products. So if you look at their catalog, they now have like tape and like.
And what does your company have?
They're more like technical. So you would say like anything on a industrial big product.
So you don't think Amazon will come into your industry and disrupt you too?
Well, so kind of my reasoning behind that is you need people to most likely install these parts, which is the big kind of thing. So say something like tape, I mean, it's not as technical of a knowledge. I think that's the part that stood out to me about AIT is you need technical expertise to use these products.
Michael, I just wanted you to talk a little bit more about, you kind of mentioned investing in technology and investments in automation offerings. Can you just talk a little bit about kind of like expanding on that?
Yeah, so it might be my second driver. I talk about the like next generation of industrial solutions. So, right, there's a really tight labor force right now, and the only way that companies are kind of able to go around that, or at least that they're seeing, is investing in automation. So if you want to be this kind of full forced, we can give you the products, we can also integrate solutions and things like that. You need to build out your automation. So I referenced 4 acquisitions. Now they're smaller base acquisitions, I think mostly because a lot of them contain goodwill, because they're like one of them was 15 million were intangible. So I'm assuming they're acquiring whatever intellectual property that they have. And then you have a company like AIT that is very big and can kind of upscale those operations. So
how does that compare to kind of some of its peers? Like what are they spending?
Yeah, so a lot of the peers are focusing on kind of supply chain. So AIT has that service component, but like Grainger, for example, is really known for their supply chain. So they'll have those products, but they'll also come to companies and their services will help you with your supply chain, inventory management, things like that. And AIT has it, but just not on the scale that somebody like those companies would have.
Gotcha. Thanks.
I've always got more, so we'll keep you rolling. Walk me through this WACC thing, right? I can't see your cost of debt. Can you tell me what you use for an after-tax cost of debt?
Yeah, so I spoke with the people that were in here because I was using 2.9% and then the whole risk-free thing. So I increased my my after-tax cost of debt to 4.5%.
Okay, what risk-free rate are you using?
3.5.
So that's something we're going to have to talk about as a class. Dr. Valentine and I think are on the same page. This week, it's the first time some of you have started to show up, which I appreciate. I'm noticing the risk-free rates are varying between 2 and 4. We probably should reach consensus on what we're going to use so that we don't have so much variance in our DCF approach if we're going to use those. 3.5 is totally cool. I don't have any issue with it. I think that's where Duff is right now. So, but we'll probably need to talk about that as a class. Good point. And then my last one for the moment, until we get our next person, is you mentioned that you thought margins were going to become less aggressive, and yet I noticed right as rain, your operating margins are growing 0.4% out to the horizon of what I can see. Does that ever stop? Like, is this company magically able to expand margins forever?
Well, so I guess my reasoning behind that is I went back to last time management gave guidance about where their EBITDA margins would be just to see how closely or how aligned it could be based on what they're saying. We think, I forget what the number was, maybe it was 8 or 9%. And they're pretty in line with that. So they said by 2026, they'll be at 12% EBITDA margins. I think my last year, I have it about 11.6. So an extra year and 40 basis.
And do you taper it ever in your terminal year, or are you just growing it right into the horizon point?
I do have it growing into kind of horizon point.
Okay. Yes.
Yeah, so I kind of asked about this on D2L, but I think it's like pretty important to bring that up. In terms of your first driver, I guess like to pinpoint the question, what do you think, in your opinion, drives the stock the most, and how did you forecast that?
I think, so if you look at the stock price over the past 6 months, it hasn't dropped as much as other industrial companies in general. And I think that's the service component. So I talk a lot about a recurring revenue base, and that I think when ultimately production slows down, you still need servicing. You might not be having those capital expenditures of getting new equipment, but if your equipment is running, it's going to break down. So you kind of are left with the fact of, okay, do I go out and buy a new piece of equipment if my cash flow isn't as high, or do I just, buy 5 replacement parts and have those put in? So I think that service component is kind of where I stand on if there is kind of the economic slowdown, you still have service.
And then how did you forecast that? Like what percentage is that of your revenue growth going forward, or how does that factor in?
So I kept the service component fairly flat because I think just that's not what they're trying to go into. And that's kind of the point about the recurring revenue base is it just grows kind of with GDP or incrementally as time goes on. But the fluid power is really where they're focusing their efforts on. So,
Dr. Valentine.
So, one of the things that you're going to get this question a lot, guys, and this is part of the new template, is I'm always curious to know what is consensus missing? Well, why is the rest of the street not understanding the thesis? And what is the catalyst that's going to get the street to come around your thought process?
I think just in general, so I spent a lot of time looking at the manufacturing capacity of the United States and just seeing how that has kind of gone over time. So when you have time, so I kind of saw that 75% is kind of your numbers. Once you fall below 75%, you see really decreasing for the next about 6 months after companies' profits really start to lag. So right now it's a
Sorry, 75% of what?
75% capacity.
Of capacity, okay.
Yeah, so right now it's at 79%. So I said, okay, well, I at least have first half of 21 most likely, or first half of 23 for this company, most likely. And then say it does start falling off, that at least brings me out to maybe 16 months out. And then, so I think a lot of it was captured in my fiscal year 23.
So do you diverge from the street right out of the gate, or how much higher are you on your EPS than the rest?
So it's 5 cents in 23, and then in 24, I think I was about 16 cents.
So and do you think that the street has factored in a potential recession or a slowdown?
So this company only has 3 analysts, and I couldn't look at their. So Wells Fargo used to cover it, and Refinitiv has Wells Fargo's sell side report. So that was really my only sell side on what street analysts thought about the company, and they have favorable outlook and just kind of talking about their business model and everything like that. But the 3 on facts that I couldn't look at their kind of projections or what they were saying about it. So, I mean, I couldn't give you a definitive answer because I didn't know what they were factoring in. I guess going forward, that's the whole point, is being able to look at their.
Well, my only word of caution or concern is when you said, gosh, last time they guided us to a number they got there. Last time, was it 2000 or 2008?
Yeah.
When was it last time they did this kind of?
Oh, 2018-ish.
Yeah, and so I worry a lot about cost of labor right now and inflation. And so while management hit a home run back in the time when things were going pretty decent, I worry a little bit about trusting them to just right as rain. This is an awfully smooth curve you forecast. The good news is the DCF, from what I can tell, you've attempted to quantify like a couple minor shocks in the system, your sensitivity, and it looks like our downside is limited. The bad news is we may be stuck out a flat one if things don't work out the way management thinks. Yeah. All right, well, thanks. Next up, Aidan. And so one of the things, Dr. Valentine, I want you to do is really scrutinize these companies quite a bit, right? There once was a time, this is in relation to your write-up, I'm not speaking, where the student class was pretty discriminating on what they would add to the portfolio. And while we're we're practicing right now and doing some things and trying out new formats. This is probably a great time to reset and say, you know, just because they're your friends, this isn't why we add things to the portfolio. We add things to the portfolio because they make sense. They know why they differ from the street. The things they quantified make sense to us. Basically, we're PMs, right? And so try to take the friend side out of it. That's crept into the program a little bit over time, and try to focus a bit more on, do these all make sense to us? And if they do, then by all sakes, we'll stay at our big average that we've been adding things. But I can tell you lately, the average crept up to 70, 80%. I used to shoot classes out for that sort of thing. Maybe I'll have to come back under my thicker skin version of myself. But when I arrived here, we had a similar problem. In the first year after I arrived, we dropped down to about 30%, which made me much happier. Somewhere in between is probably what's fair, but try to put a critical eye on things and not just think about the relationship you have with the person and if they're going to vote for you or not. Make it less political and more analytical. Fair?
Can you help with
Yeah.
that? So you're saying if 80% are being selected, 80% could be above average.
Yeah, they're just that good. And it might be true, right? I mean, the program has performed well, but it's performed well in a time when we were selecting things, if we were being honest, based on some momentum factors in a market that was kind of pushing that. We're not in that market right now. It's going to require a lot more activity. I've been through a market like this, Dr. Valentine has, and I can assure you, as you're seeing, it's rocky. Rocky markets aren't easy to just say, hey, I found a rocket ship with great tech, and therefore it's just going to keep on flying along.
Yeah.
It requires some real selectivity.
I looked at the portfolio maybe about a week or two ago with Dr. Krause. I think it's underperforming the mark or its benchmark by 800 basis points. So year to date, it's either year to date or the past 12 months. So, you know, I think we need to be a little bit more discerning in what we do in the portfolio.
That's what happens when you shift from a momentum-based market to one that's based more on fundamentals. Fair?
Fair.
Now, with that lens, not trying to set you up for failure by any means. This is not a comment. I haven't looked closely yet. We got Capri Holdings, and if you could walk us through, if you had something, especially if you think you had some novel approach to your screening, right? What I've started doing this week is I first started meeting the first batch of students, and a lot of it, I was thinking it'd be more developed, but actually we had some good discussions about screening. Well, Dr. Valentine won't love when we didn't have a standardized approach. I think we had some really unique and good approaches that were relevant to the industry they were in. So I'm hoping that if you can't come up with a way that we can all use, you can at least tell us why it's so relevant to the industry that you're pitching.
Do you know what the homework assignment was for
I don't.
doing this morning?
Learning how to screen.
And and sharing what they do to screen.
Well, there we go. So you'll be an expert at that. Take us away. Talk us through that if you would, please. Thanks.
Hi, everyone. I'm Aidan McGuire. I'm a senior in the AIM program. Today I'll be pitching Capri Holdings Limited with a price target of $56.14 and an upside of 32.18%. What really drew me to Capri was, and with really all the stocks that I've pitched thus far, is something that a lot of us can understand. These products are products we see in our everyday lives or hear about with Michael Kors, Versace, Jimmy Choo. And they're known globally, being sold through over 1,200 retail stores. I would say a question or a concept that came up on D2L was involving the WACC calculation. I also had that issue with my cost of debt. So my risk-free rate is 3%. I raised my cost of debt to about 4%, which drove my WACC up to 11.3%. Bringing my price target down to $54.44 and lowering my upside by just about 4% to 20.2%. So with that, any questions?
Yeah.
Nope, we got one here, then two, then three.
Hey, can you just touch on your rationalization for keeping a flat operating margins and why those don't fluctuate from 4 years?
Yeah, I think with the expansion they're going through into Asia, with the growth initiatives they've come out and said with the 300 retail stores that they're going to begin working on, they didn't exactly develop a strict timeline on that. So I expect it to be in the near future within the coming years, but I didn't expect it to come next year rather and have a large percentage growth.
Do you think that with some opening new stores that there would be a compression in their operating margins just from like opening new stores and just more overhead or anything like that? Or you think there's something else setting that?
I would think so, but not too much for concern.
Yeah, so I realized that this company is kind of in the luxury brands category, and especially with rising costs and inflation kind of coming into fruition like right now. Have you done any correlations to how this company is related to CPI? If so, have you factored that into your model?
I did take a look at the CPI. Their year-over-year growth, which I believe was from June of last year to June of this year, the apparel segment was up 5.2%. Inflation-wise, I know Europe's going through a particularly rough recession right now with inflation hitting about 10%, but they only make up about 18% of the revenue for the company. So that doesn't concern me a ton per se. With a potential recession coming to the United States, I think they'll handle it very well.
Hey, I noticed your beta's 1.6, and we're going into the market's extremely volatile. So I was just curious your thoughts on adding a company that has that high beta that's going to be pretty, or has shown to be pretty exposed to the momentum of the market.
Right. I think with them, or with really any company being in a luxury category, there is going to be some risk involved with that, just because it's not your common everyday item that you might see in a consumer discretionary company. The 1.6 was gathered through definitive facts and then my own computed beta. But I think at a time like now, luxury goods are at a premium. They're going to hold their value through the coming years. And I think that's really attractive interest.
So are you saying like the product itself becomes like an inflationary hedge, or like a market stabilizer?
Repeat your question.
I'm just saying, like, do you think, are you saying that the product itself, maybe not detached from the stock, but like luxury goods during an inflationary period or high market volatility is stable enough to offset the clear volatility that the company's stock demonstrates?
I think it is, and given particularly the success of Michael Kors and how much revenue they drive for the company, I think those products in particular are going to hold up very well.
Grace.
Yeah. Hi, Aidan. I have a question on the first driver. So you say like that Versace grew to be from like 2.1% to 19.2% of sales, but I see your revenue kind of or your sales in that area hasn't really increased all that much. So kind of, can you explain what happened there and why they now?
You're asking about their sales and how they haven't really.
How did they have that like massive increase, especially since the company's sales haven't really increased?
I think just integration into the brand. Before it was just Michael Kors, and then same year they also added Jimmy Choo along with Versace. So I think with the integration in the company, it was able to grow over those coming years. And with the growth I talked about, my first driver, I think that can only go up from here.
And then also is for the revenue, is that in billions or millions?
Millions. That's a big one.
Hey, kind of going off the discussion we had before you started your Q&A, especially with consumer discretionary at a time in an economy like this. So I guess two-part question, like a pretty general question. Why should we add Capri to the portfolio like during this economy? But also on the flip side, what would you like plan on selling if that was the case?
Yeah, thank you. I think back to Alex's question to answer that. I think the products that they're going to offer are going to hold their value over time, which in part is going to make this company be more attractive. For a sell recommendation, I had two in mind. I was in between selling Helen of Troy, which is down about 60% year to date. It just didn't handle the economic volatility that we went through as well as I thought it would. Or I was thinking about trimming Sony. I can't, and would not like to completely cut Sony out of the consumer discretionary sector that we have. Given that we have L'Oreal and Lululemon, we have these apparel accessory brands in there. I feel like it would lack the diversity if we got rid of like a tech company like Sony.
Yeah.
Two-part question. First, why is your target price almost 20% lower than consensus target price? And then second, if your premise is that this is going to hold its value in an inflationary environment, why are people buying Michael Kors over Rolex?
My forecasted growth is a little on the conservative side. I didn't want to, especially in this industry, I didn't want to kind of push that limit. I wanted to keep it something reasonable. With Michael Kors and the products they offer compared to Rolex, one, they're on the relatively cheaper end compared to Rolex, and they're more for like an everyday use. I feel like.
Dr. Valentine.
Would you consider VF Corp competitor?
I would, yes.
Because I think they've been a big whiff yesterday or the day before, and they've disappointed 3 times in the last 4 or 5 months. Do you think that there might be something, kind of getting back to the point coming up in the room here, is that should we be more concerned about this idea of when you go into recession, you see disposable income decline? It feels like your company caters to companies' disposable income. So I guess, can you get us more comfortable with this idea that this company, maybe not is recession-proof, but that it'll do really well in a recession, given all the concerns we're hearing in the room, and this idea that, at least from my perspective, I just assume that they generate revenue off of disposable income.
Yeah, as you can see in my peer boxes, I weighted them 10%. Given the market cap that they're at, their PE to EBITDA, I felt like weighting them at 10% was an appropriate amount. I think to become comfortable or more comfortable with this company, I think what can be underestimated and what I really want to drive home is the areas that they're looking to expand to. You can see in my second drive that Michael Kors is entering a children's wear market, which is something totally different than they've ever done. With Versace, they're looking to grow that brand and become over 20% of their company's revenue. And then the Asia Pacific expansion with that luxury market growing over the coming years, I think something that can be easily looked over is the growth that they're looking to incur over these coming years. And I think that's something that can become really enticing for this company.
So let me clarify. So I think what you're saying is that there's some new organic growth things they're doing with new product lines or new geographic regions that you think will mitigate the potential impact of a recession.
Yeah, it would be foolish on my part to completely disregard a potential recession coming, whether it's here or in Europe. But I do think with these initiatives that they're looking to go upon, that it can sustain a recession.
Kendra.
Yeah, Aidan, great presentation. So I know that in China alone, there's a huge like knockoff market, and after a quick search, it was like anywhere from upward of 20 billion to 200 billion. And building off of Dr. Valentine's statement with less disposable income, how do you see their growth into the Asian Pacific market being affected by the knockoff market and the less disposable income, considering they could get something cheaper, but then for cheap?
I didn't do a whole lot of research into that knockoff brand, knockoff market that you're talking about. I think with any company that can become a slight issue, any of these premier brand companies where you're trying to get their apparel for a lower price, maybe it's not authentic. But I did not do too much information into that.
I'm going to finish up with I'm going to piggyback both of those, well, the last two a little bit and say, real quick one, I know they're in the UK. What percentage of their business is UK driven, roughly?
I believe it's about 2%.
Okay, so not much, not worried about that. We'll call that not material, we'll go Dr. Valentine. But Asia Pacific, can you help me understand which country, right? Up till now, again, we've always been lovely in just saying, Asia Pacific is gonna grow. But there's an awful lot of countries in Asia Pacific. Can you help me understand which one is driving all of this, right? We got like 33% growth coming in Boomtown. I'd like to know which country I can look at.
Yeah, if I have.
Because I hate it when we call out basically 40% of the planet population and just say it's gonna be somewhere in there.
I thought I had the specific country and country breakdown. So I'm unsure about what specific country that's going to drive.
Probably be a really good idea to know if that's a driver and that's presumably what's differentiating you from the street. I'd like to know, because if you're pointing at China, they've fallen apart recently. They're not the go-to they used to be. If you're pointing at Singapore, I could see some things, right? You're pointing at Taiwan, there's some obvious problems, but I'd like to know if you could follow up with us, which country it is and why you're so passionate about that country really being able to sustain this.
Of course.
Thanks. All right. All right, next up we got Zach. Same thing, Zach, you're in the hot seat. If you could walk us through how you found this company in particular, and then anything you want to follow up on before we get running.
Yeah, thank you. So today I'm pitching Andritz, the ticker is ANDR, with a price target of 61 euros and 31 cents, or $59.54, representing a 38.1% upside. So really in terms of my screening process, I was really trying to find some type of leader in a niche operating market. So in the operating segments like pulp and paper, hydropower, and metal forming, and separation as well. And then more specifically in terms of my screening process, I had a base just screening for ROE and ROA, with ROE above 20% and ROA above 4%. And then just screening down, adding a little bit, tweaking, adding a little bit more parameters.
Those forward returns or backward returns you screen?
Forward.
Okay.
Yep. And then PE as well, and tweaking from there. Two things I want to cover just beforehand. In my evaluation paragraph, I have the weighting at 70, 10, 10. That's a typo. It should be 70, 15, and 15. But the price target is remaining the same. It was just, I forgot how to do math there. And also I got a lot of questions on D2L about my second risk, I think it is, and it's the first risk, about the energy crisis. As the price of natural gases and electricity goes up, the demand for their hydropower segment will just go up as well, because it's more of a cheaper way to generate electricity. Historically, they haven't really had any major issues in terms of their supply chain. Even when like COVID hit, for the issues that did arise, they were able to adapt quickly. So I'm confident in their ability to kind of manage that aspect. But I did also add just 10 basis points in terms of the WACC in case anything does arise. But
seriously, 0.1?
10 basis points?
Yeah.
Yeah. Yeah. Well, sorry. Well, they did say that they're also stocking up on inventory as well. So there's that. And I guess I'll just bring it over to questions.
Yep.
This is going to be like a two-part. So first, I guess what for your EV to EBITDA and your forward PE, are you using next 12 months or like fiscal year? What like year are you forecasting that to?
Next 12 months.
Okay. And then can you give us so the revenue growth and then the earnings growth? Can you break down which one of your drivers is the leading cause of that growth, and like what percentage is helping grow that? Like, I'm trying to put together the math on where the growth is coming from.
Yeah. So historically, the pulp and paper segment has been the majority of the revenue. I think last year was 48%, between 40 and 50% of revenue. So that's contributing obviously a lot to that, as well as the hydro sector. I'm expecting that to increase year over year as well, just because of the energy crisis and people switching over to hydropower.
Okay, so which one's growing more though, and for both top line and bottom line?
You're asking which one's growing faster, which one's contributing most?
which one's, both contributing to growth and growing faster?
Well, the pulp and paper is 50% of revenue, so that's going to be contributing the most. Probably, and I have the hydropower, probably growing the fastest as well. Pulp and paper is one of their oldest segments, and that's kind of what the company started out to be as.
Okay, thank you.
Yep.
So I had a question about earnings. I want to make sure I'm doing this right. It's the thing in euros.
Mhm.
So you're at 411 for next year, which
Sure.
is about where consensus is, or 409. But when I look at next 12-month earnings, right now they're 404.
Mhm.
But 5 months ago they were at about 420, about 430. So the point is that the consensus has taken their numbers down from 430 a share down to 404 over the last 4 or 5 months.
Mhm.
So basically, estimates are coming down. I guess first, why are estimates coming down? And how concerned should we be that you and consensus will need to revise down your next year's estimates?
Yeah. Well, I think to answer your first question, a lot of the reason why consensus is going down is because of both the economic state of Europe and geopolitical tension as well. They're sort of indirectly impacted by the energy crisis. And what kind of was your second point of it?
Well, so
Why-
estimates have been going down.
Sure.
And right now, you and consensus are pretty close to each other.
Yeah.
Do you think that trend why is that trend? Presumably, if we're going to recommend a stock, we don't think the estimate's going to keep going down, right? So I guess why is that trend going to stop now, having been going up for 4 or 5 months now?
Yeah. So I think I have two reasons for that. Number one, I think they're going to do a better job in terms of managing the supply chain and also increasing their order intake. I think and management has expressed that they still see a lot of influence with the projects and investments that are coming in the pipeline, and as well with the demand of hydropower as well. And then also their M&A strategies as well. In the past 3 months, they've acquired 3 different companies. So I have that generating 6 cents towards EPS at the end. And then I think I got a question on these, well, I should probably answer that as well. And those were both purchased by cash as well as one of their loans.
So I guess I'm still trying to understand, because you said that the reason why the estimates have come down from 430 a share to 404 a share has been due to macro concerns.
Sure.
And you said the way they're going to mitigate that is company-specific concerns. I get confused there. So
Yeah, so I think I can kind of touch on that in terms of their backlog as well. They have a backlog that's supposed to span until Q4 of 2023. So they kind of have a little bit of a buffer to at least deal with those problems and create a strategy to mitigate all that, I guess, the macro risks.
August.
2 basic ones, but why has this company underperformed the index for the last 5 years? And then, do you happen to know offhand, like what adding 300 to 400 bits to your WAC would do for the ECF?
Sure.
Real quick, just so you know, like, you may want to clarify which index, because
Yeah, the Austrian index.
well, at least what I'm looking at, 5 years, it's been about where it was 5 years. So the stock was 72% of its relative to its index back 5 years ago. It's 76% relative to its index now. So it really hasn't underperformed its index.
No, Dr. Valentine, for reference, looking at the ETX. You might be looking at a different.
Okay, I guess I answered that.
Yeah. Yeah, I was also using his index. That's the one we found in your office the other day.
Okay.
In terms of the effect it would have if I had 4 basis points, you said?
Yeah.
400, not 4 basis, 400.
400 basis points? I didn't see what it would look like at that with 400 basis points. What I will say, and I know Dr. Valentine had touched on this, with increasing my risk-free rate. Right now I have it at 275, though if I increase it to 3.5% and then my cost of debt at 4%, it really has not much effect. It would just, my current WACC is 7.16%, it would only make it to 7.14%. So at the end of the day, it wouldn't have much of an effect on that.
So hold on, you just say you're raising your WACC by almost a full point. It doesn't have much impact on your valuation. Is that what you're saying?
If it was from 7.16% to 7.14% afterwards.
But I thought you said you're taking your risk-free rate from 2.5 to 4.
3.5, and my cost of debt's 4.
What's your cost?
But did you change your cost of equity? No.
No, I actually didn't. Okay.
Which is part of your formula, right? So
Okay.
you affected one.
Okay.
If
Yeah,
you,
right.
if you moved your risk-free rate, so did you change your risk-free rate or did you change your cost of debt? Or both?
Both.
Yeah, so the risk-free rate should have had a dramatic effect on your cost of equity.
Mhm.
The cost of debt should have had a minor effect, if this is right, because you're only running 11% debt to equity.
Okay.
But unfortunately, we need you to rerun those numbers
Yeah.
because the cost of equity is 90% of the cost of this company's business, and that's gonna have an impact. And then two, I want to be clear, like, it looks like you're pitching me ANDR, which is 4 cents a share. I think we're going for ADRZY. It took me a little while to figure out what the heck we're buying. Does that sound right? Like an OTC?
I think that's the 8, yeah.
Yeah, so we're not on the NYSE. We're
Okay.
actually dealing with NASDAQ because the NYSE product's ready to be delisted, but it's not the same company. So want to clean up some conception issues. And then
Sure.
my own question is the same thing. Again, we're back. This is starting to interest me. Margins, right? We just keep increasing these right as rain year after year after year. I have yet to see a company that's able to achieve what I've seen two pitches in a row now, where we've got operating margins that are nice and smooth and growing out to the horizon. Do you have a reason for that?
I think just in terms of the order intake, I think they have a lot of growth potential in the future as, with their,
So nobody wants any more. You don't want a higher salary, right? If the company's growing.
I did actually increase SG&A.
Oh, good.
Yeah.
Out to the terminal year?
I increased in 22, I increased it by 50 basis points, and then I think I did 30 basis points in 23.
And how about in the terminal? Flat, up, down?
Yeah, flat.
Okay. Any other questions? All right, thank you. All right, next up, Owen. Walk us through your screening process, please. And, you have any last minute cleanup type stuff?
Well, hi, everyone. My name's Owen Filbin. Today I'll be pitching Lumentum Holdings. So kind of two things I use for my screening. I wanted strong EPS growth historically, and then both kind of catalysts for EPS growth in the future. And then to touch on Dr. Wall's point earlier, like why I picked this versus other firms in the industry was I wanted a company that could weather, or whether you think there's speculation of a recession or not, there's definitely point signing to that. So I wanted a company that I felt comfortable weathering this, and I can get into later why I think that's the case. But there wasn't any like really pressing questions. There was kind of a wide mix, so I'll let you guys ask those if you want. But other than that, I'd be happy to answer any other questions.
Yes, sir.
Yeah, great job, Owen. I think you kind of touched upon this in D2L, kind of scaling through it, but your second driver, you're talking about those reduction of 3D sensing sales,
Yeah.
which, they like dying for, totally get that. But I'm curious, when you give your market CAGR, for the laser segment, is that the growth CAGR for the market or for the segment itself?
Yeah, so I forgot to add, that's for the market and it's to 2025.
Okay.
And I can provide the links after if you want.
Yeah,
I forgot that.
so then I guess thank you, but what's the effect of that driver on your forecast for the next couple of years, or at least 2023?
Yeah, so I'll address the 40 to 50% now because that also came up. So historically, Lumentum has been Apple's sole provider of their 3D sensing. So think iPhone, iPad, etc. So for 6 years, they've pretty much owned that market. So my point in that is, I think the whole 40 to 50% is a little exaggerated. Like they had 90% market share, so that's just kind of cooling off now. So that is like allowing them to cater a lot of their resources and R&D into the telecom, datacom with their acquisitions. So that was kind of driving my second driver.
August.
Just looking at your ROIC and WACC, have you quantified what year this firm's going to start bringing value?
Yeah, so historically it's been low, and I guess, well, do you want my whack too, or just the RC?
Just what year then?
Yeah, so I have it after 2024 is kind of when they're gonna start getting over. They've historically been very profitable, since 2019 and 2020 was kind of their, leveling out in most terms, but, yeah, 2024 is kind of their hotspot right now.
Looking at consensus, you're right in line, based on within a penny at 781 for next year, you're right within a penny of consensus. So can you walk us through what you think the street is missing? Why do you think there's still so much upside here?
Yeah, so, well, I don't necessarily, I agree with most of the street. The only thing I disagree with is management's guidance for double-digit growth into the perpetuity. So I actually disagree with consensus on that regard. I still think it's a buy. I still think there's upside. So into fiscal year 25, I agree, but I don't agree with management's guidance that it's going to grow double-digit revenues for perpetuity. I think that's a little optimistic right now.
So ironically, my question is literally, sorry, did you have more? I don't want to.
Well, I just want to make sure you're fair. So you're saying you think management's too optimistic?
I agree. I agree with consensus, but I don't think it's as high as what management's saying.
So you're saying management?
I think it's toned down.
Consensus isn't buying into management, but you're in line with consensus.
Yeah, and they are consensus journalists too. They're saying double-digit growth into perpetuity, and I think that's a little optimistic.
But I'm seeing consensus in 25 being at like 818, and all of a sudden in your model, you follow your pattern on the growth, right? You drop to 3% growth, but again, all of a sudden I've got margins just expanding like crazy. Can you tell me what's going on in 25 that's driving?
Yeah.
Right. This is to me is going to be the key question, right? Dr. Valentine wants to know what the street is missing. To me, it's pretty obvious. I don't know what it is you found, but 25 must be what you think is that everybody else is missing.
In terms of operating margin?
Just in general, 2025 differs in so many ways, right? I've got barely any revenue growth. I've got an explosion in margins, and I diverge from the street by 68 cents, which tells me that you found something everybody's missed. Can you help me understand what that is?
Yeah, well, in terms of the operating margin, it's actually not going any higher than it's ever been. So it's actually just growing back to historical levels. And their guidance has shown that their target model is to get to 30% operating margin. In terms of revenue, I would say it's a little low. I probably
That's not my question. My question is literally, what is it that you found that everybody missed? Because it's super obvious it's in 2025. I just need help. I need help understanding like what it
Can I
is.
ask one question on this?
Yep.
So the consensus for 2025, you don't think analysts make that up? Because I'm not seeing you on
14.
What's that?
14.
For 2025?
Because I've only got 3 here.
I don't.
I was
Yeah,
gonna say, so, okay.
I'm not sure about that. I know 14 make it up.
The reason I bring it up is that, and I fully agree with Dr. Wall's question, that you get this kind of hockey stick thing in the last year. My only point is at this point right now, given we left 2022, anytime someone mentions consensus to 3 years out, I tend to wonder how many people make up that consensus.
Okay.
But we still haven't got the answer to the question though, in terms of why.
Yeah, what is driving the 2025 explosion in your numbers since it isn't sales? Help me understand that.
Okay. Oh, I see what you're saying. So
Yeah.
I see what you're saying. In 23 and 24, they're aggressively hiking up R&D after their recent acquisitions and SG&A, and that's tapering off the tab.
Okay, so they're not gonna, I see where you're headed.
Yeah.
So even though sales don't grow, they're just gonna
Yeah.
stop spending on R&D.
Yeah, sorry, I didn't really.
Okay, that's what's driving it. Got it. Other questions? Yep.
Over the last year, they've repurchased a lot more stock than they've generated cash for. Do they have plans to continue that going forward and continue to leverage the business? Or?
Yeah, they're planning on continuing that. I mean, they haven't quantified it. I know their big one was 900 million shares repurchased. So beyond that, I don't know.
Do you consider 12% a high short interest? Why?
Yeah, the question was asked. I don't think right now. I mean, I think I usually consider like 17, 18, 20% kind of high. And right now, like, people are buying it, people are shorting it. So I don't think it's
Why would someone be shorting? Like, what's the other side? What's the
Yeah,
the
I
bear
can-
case right now?
Yeah, I can kind of get to that. So, well, in my valuation, I think that this stock is experiencing recession valuation, so I think that's part of it. I also went into, in my like data analysis, I kind of looked at what their valuations have been very choppy, and my take on that is that a lot of it was outside of their control, particularly with acquisitions and like antitrust clearance. So I looked into that. I think their market's factoring in a recession right now. But if it follows kind of historical, that choppiness, I think it can go back to kind of what I have it as the, kind of back to that 30% discount levels.
Good. Thank you. All right, next up, we have Andrew. Same thing, Andrew. Walk us through how you found this thing. Take us away.
Yep. So I kind of started my screening process the same way I did for my first two pitches, kind of a pretty basic fundamental screen on FinViz, and then I kind of dumbed down in industrials, domestic, and I was looking for a play that would be more of that would have sort of a buffer against the recession, and then have business segments that were fairly independent from GDP growth. So I really found EnerSys because one, they have 1.5 billion in backlog, which I outlined, which would help create kind of a little bit of buffer for recession over the next year or so. And then the other two lines of business in their energy systems and specialty segments are fairly independent and not as dependent on GDP growth. So one thing I kind of discussed with Dr. Wall the other day was my risk-free rate is 3.5%. My after-tax cost of debt was calculated as 2, so I raised it 225 basis points to 4.25%, and that increased my WACC to about 8%, which.
And then the same question Dr. Valentine asked: did you change your cost of equity with the new risk-free rate? We might as well skip ahead to that question.
Yeah, I do not believe so.
All right, so we're going to look for a revision of your WACC yet again. Well, actually, we can compute a little bit. Your WACC went up by how much?
About 90 basis points.
All right, and how much of your company's debt to equity? All right, we can do some quick and dirty math together as a group, and then we'll ask you to follow up. Oh, it's almost all debt.
Yeah.
Okay, so an equity change won't change.
Yeah.
Great. All right.
Yeah,
Finish
so
your thought.
yeah.
So yeah, it won't affect anything. 1% equity is immaterial.
Yeah. So after dropping that, my weighting 50% on my DCF dropped my upside from 20% to 10%. So I just want to make that note before proceeding.
Thank you. Question?
Pretty much being all debt, what does that do, and have they been lowering the amount of debt that they have?
Yeah, so the most they have 2023, they have 300 million due, which is fixed. Then they have about 800 million due in 2026, which is floating, and 2027 they have another 300 million, which is fixed. And about 100 basis point increase in interest rates will result in about a 9 million-ish increase in interest expense.
Have they been decreasing the amount of debt?
Yes. Actually, this past year they've increased their debt as they're investing in increase their capital expenditures. But after this, it's going to be on a decline.
Seems to be my favorite question of the day. Can you help me understand if this wonderful margin expansion continues out forever, if you ever or tapers off at any point in the model?
Yeah, so I do have my margins for about 50 basis points per year, and that's honestly because their margins have fallen off so much historically. So their gross margins have been hovering around 25%. Right now they dropped down to about 21% this past year, just due to supply chain constraints. A lot of that, the operating expenses from their backlog was realized. None of that revenue has been realized yet, so that's hurt as well. In addition to just freight expenses, which have been extremely high. And I do have it leveling out at about 24% gross margin in 2024, 2025.
Thank you. Yep.
Yeah, I guess like same age-old question for me today, but your first two drivers how are they affecting the next 12 months earnings growth, and then I guess into perpetuity what you have forecasted?
Yeah, so about 50 for my first driver, the 5G build up. So about 55% of their backlog is built up in that, and those orders are just starting to get released right now and this past Q1 of 2023. So a lot of that price mix is starting to get realized, and that'll have a great effect on drivers. And again, these two 5G build out driver, that's the least dependent upon I guess recessionary terms, just because a lot of it builds up in backlog. And then for my second driver, that actually has the most exposure to I guess a recession, but the CAGR, I have a 9.5% CAGR on the kind of transition from gas powered forklifts to hydrogen fuel cell forklifts, and that's growth is not forecast to slow down with recessionary terms. So that I'm not too concerned about that.
But like,
Yeah, good. I lost who's two. You know where you're at. 2, 3, 4. You're 2. Thank you. Go ahead.
Andrew, I saw with your second risk, you talked about like currency risk. How do you see that affecting your company like long term, or maybe even like short term?
Yeah, so about 24% of the revenue is derived from Europe, and yeah, definitely had in this past quarter offset revenues by about 400 basis points, so made a big difference. They do have currency through about 300 million in swaps in place for a currency hedge, and then kind of forecasts that I looked into just for Euro over the next couple of years is over the next 2 quarters expected to trade about parity level with the dollar, and then in line with the dollar, be in Q2 of 2023 to the end of 2023 trade about or be about $1.04 relative to the dollar. So it is predicted or forecast to stabilize a little bit, which will definitely offset some of those headwinds they were facing from that.
You got it through. Go ahead. Yeah.
Okay. This kind of goes along with the margin question, but over 2020 and 2021, a lot of money was raised for battery tech companies. I'm thinking specifically a company like QuantumScape, which raised 1.5 billion, and they're not even promising revenues until 2025. So how is this competition that's coming in going to affect their margins and their place in the future?
Do you mind me asking what their end markets would be for those for industrial applications?
Well, most of them are EV, but the QuantumScape also works towards like industrial scale.
Yeah, so the only exposure they have there for EV is in their specialty segment, and that's only makes up about 35% of their specialty segment. So I'm not too concerned about that, as most of all of their battery manufacturing applications are all industrial applications and aren't kind of quite related, I would say. So I understand kind of what you're saying, but and again, I think they hold a 22% market share in that as well. So I feel like they have some strength in their relationships in that sense.
August.
Yeah, what value does the chart in your appendix add to your pitch?
Yeah, so I actually did a little bit more in depth. So this is actually in relation to my motive power segment. So for the hydrogen fuel cell forklift, so those are their 4 biggest competitors, and I went into a little bit more detail. So motive power, their products are called Nexus, some EnerSys, and I compared those 8 products. I did a trend analysis on those compared to most of the top 4 competitors had about 3 or 4 products that they specialized in, and same thing with internet traffic was greater in 5 to 7 products, which is something that I think would be more services. Customers are looking for those solutions rather than kind of like a company name, which I realized kind of after I already pitched it.
So how do you get the internet traffic data?
Google Trends.
Awesome. I'll turn it down. So can I jump in here real quick? So the company was expected to earn about $6 a share over the next 12 months back in 2018, 2019, 2020, 2021, and now.
Yeah.
So why, for a company for 5 years, is expected to earn about $6 a share? Why would we want to add that to the portfolio?
Yeah, so EnerSys being founded in 2001, still for the new company, and
oh, that's right. A 20-year-old company new?
Well, in terms of they kind of came and as a player as a traditional lead battery manufacturing company, and now they've shifted and made over 30 acquisitions in the past 15 years to build up that energy segment that they did, or energy system segment they didn't have, which has allowed them to, they used to be in only 3 end markets, now they're in 11 and have kind of taken a complete kind of 180 turn as far as who their, I guess, customers and end markets are serving are. But more to answer on that, it was kind of hard to go back and look at that because their energy system segment has grown so much in their specialty segment over the past 3 years now.
Sorry, but it's not growing earnings. I mean, it's maybe growing revenue, right?
Mm-hmm.
Is it possible this company's getting into segments that are either very competitive or just very, very low margin?
Yeah, so it's definitely low margin, and they're definitely known as not one of the more profitable players. But
I thought you had the margins going up.
I do have their margins, but they were that's a historic all-time low for margins. So I just kind of leveled it out, and they were at about a 25% gross margin. I'm about 100 basis points below that going to perpetuity. So I just kind of normalized it a little bit.
Yeah, but I guess. Okay.
I'm guessing your last pitch was on Coin.
Yep.
You might have forgot to change the box template in the things. We have a question online, which relates to that in some ways, right? In your boxes and your peers, you've got it listed as OC. But online, I think what they're asking, because of that mistake, is can you tell me why this is a buy over Generac, which is much more profitable, and also are you recommending that we dump Generac?
I am recommending that.
And why is this, not only is this better, but it's so much better we should dump the other one? That's the question that's coming in online.
I mean, if you look at Generac's performance over the past year, or year to date, it's down 50%. Past year, it's down 60%. And Generac and EnerSys kind of are competitors, I guess you could say, in the broadband and telecom. So obviously, Generac holds a much greater market share of about, I think now it's about 35%, I want to say. And I just think they operate, I think EnerSys just is a better buffer against a recession. And I wasn't really playing it as a complete, like, this one versus this one really complete equals. I was more just saying, I think that underperforms significantly.
But it is worth noting that, as I mentioned, your company's at $6 a share of expected earnings for 5 years now. And Generac 4 years ago was expected to earn $6, and now they're expected to earn $13. So this management team seems to understand how to grow business. Now you're right, the valuation's higher, and it has actually it's not much higher. The stock's underperformed, but as Dr. Paul was pointing out earlier to me, a stock underperforming so far year to date does not necessarily make it a stock that you want to necessarily sell at the expense, because otherwise we have computers that do that all day long, right? Mm-hmm. They just sell underperforming stocks and buy outperforming stocks, and it would be endless.
Mr. Walker, clean us up.
Discuss the 15.5 multiple. What analysis went into determine the 15.5 valuation?
For the market multiple, that's what I used for the market.
15.5 is the market multiple?
Yeah.
Okay, did you doing an analysis whether or not the stock has ever traded at a premium or a discount rather than just assuming that it's going to trade at a market multiple?
Well, I have that as my market multiple, and my stock historically trades about a 22% discount. So I discounted that and then used that as my valuation multiple times my 2024 earnings.
All right, thank you. Last but not least, Richie, you got TTEC Holdings, right? Walk us through how you screen for it if you could, please. And then if you have something to clean up, do that, and we'll take it away from there.
Right. Hi, everyone. I'm Richie. I'm a senior in the AIM program, and I cover domestic information technology. TTEC is a leader in the customer experience technology services space. They deal with a variety of different CX solutions from their 2 segments, Engage and Digital. In Engage, they create digitally enabled customer care and fraud prevention services. And then in digital, they create, design, build tech-enabled CX solutions. For my screening process, I used Finviz and FactSet. I really was just looking for a company that was unique and I thought was interesting. And I wanted it to be from in a growing industry, and the CX industry really fit that criteria. And then TTEC was the company that I found that I liked the most. What they do differently is they provide all-in-one solutions, and that's something that really drew me to the company, as well as their very experienced management. Everyone in their executive team has worked at TTEC for over a decade, and most of them working in other CX firms before then. So I think TTEC has a lot of growth and it's positioned well, and that's why I chose to pitch it. Questions?
Can you tell us what happened here recently where it was about a 20% drop in EPS estimates, forecasts? In August. Their estimates down, analysts were about $5 and they dropped them down to about $4.
What that is, I think mostly what that is attributed to is just a slowdown in the market.
Should we expect more slowdown in the market?
Just it's more like a macro factor thing. I would assume not so much as TTEC. I don't have a straightforward exact answer for you, but I can get back to you on that.
How do you incorporate the new center into your model, like in your revenues and costs? What were you using for that, and what was your source of information for that?
Being that that's a relatively new development, it only happened in the last like 2 weeks or so. They don't have any exact numbers or estimates on that, but I was taking a look at the market CAGR of 60%, and being that the Africa and Middle East segment only derives they only contribute 1.5% of their earnings into TTEC. I applied that growth rate to that portion of the revenues, and then I also considered their recent acquisitions into it to further increase some of their growth. That's how I factor that in.
August. Why is South Africa so lucrative in your opinion?
It's just a new developing market. It's something that TTEC doesn't have a lot of exposure into, and it's more so well positioned in a region that is going to be needing a lot of these CX solutions in the future. TTEC is mostly in Americas and in Asia, and just opening it up into Africa and then potentially even in the future in Europe, I think that it's something that's crucial for their growth, and it will continue to help them.
Yeah, just to follow up. Do you know any comps that have recently expanded into like Africa or really any other country to do something similar? And how is that fit for them?
I don't have any exact comps, but Teleperformance is one company that TTEC named as one of the competitors, and they're an international firm. But I don't have any exact ones that have been expanding to Africa.
Over the last few quarters, the profit margins have been shrinking pretty fast. And I see that for 2022, you're holding operating margins at 10%, but over the last 12 months, they've been under 7%. Are they going to bounce back second half of the year, or where is that coming from?
Yeah, I'm assuming it's going to bounce back partially just because of their expansion into South Africa and their recent acquisitions. Being that the majority of their workforce is online, I would predict that it'd be a fast turnaround time. It would take like multiple years for them to fully start operating in South Africa. So that's what it is.
Alex?
Yeah, so it's going to take a couple of years for it to fully be realized in South Africa. There's obviously going to be some costs associated with setting that up for operation. So I guess I'm still going back to that question. I'm confused on how you forecasted that in and when will that be realized? Because, like you're showing this growth early. is it a slow growth? Is it just all at once? I'm struggling to understand how that factors into your 17% growth for revenue.
There's going to be a partial, like initial boost, and then it'll also be a slow growth just because they're mostly online, so they can like immediately start offering their solutions. And then to fully build out what they have, it will take a little bit of time. But does that answer your question?
Yeah, I mean, like it's 400 million though, like the growth. So like, how is it for like 200 million right away? Like we can expect that. Have you seen that before?
It's the expansion in South Africa, and then additionally just the extra synergies that they've gotten from their acquisitions that I've forecasted to add to their growth. I'm not exactly sure.
Thank you.
Awesome.
Yeah, your debt to equity is about 3.5 for your company. TTEC is about 3.5 times larger than all your peers. Why aren't we pitching Accenture as like a buy? Because they have a low debt to equity for 50 years. Like, what's your company doing that's like different from all their peers?
What I think that's different is just they have a larger exposure globally, and then they're more of an all-in-one solution. They kind of encompass all aspects of the CX space.
Okay.
That's what differentiates themselves. Most other companies only specialize in a few things, but TTEC kind of encompasses everything.
Okay, and then I guess a follow-up to that, do you know what their market penetration is? Like, what are they doing differently? Like, that's gonna get them ahead into the market.
I'm not exactly sure what you're asking.
That's fine, thank you.
And I've got some blocking and tackling questions and some sloppiness cleanup. So I'll start with the sloppiness cleanup. I'm assuming the growth is not 0.17%, it's 17% in the boxes. You got them all as decimal points. Please don't do that. Two, staying in the boxes, same thing. I've got operating margins now that are right as rain, 10, 10, 11, everything's, top line growth 16. But that's translating into earnings growth of 20. Can you tell me where that's coming from? How are they able to capture like much more of what they grow between top line, next line, and then ultimately net income? What's driving that boom? You can pick any year you want. I look at 22, right? I look at 22 to 23. I see that grow about 20%. I see your top line growth is 17 or 16, and then I see your operating margins are flat as rain. Can you tell me what's driving that behavior? Next one. It's okay. EV to EBITDA is what you use for multiples. I don't see them in the boxes. How am I supposed to reasonably know if you made any good assumptions on that? Please don't comp things unless you're going to show us what you comped based on. Thanks. Any other questions? Thank you. All right, I think that was our last one for the day. So, we need names. Appreciate you guys attending, appreciate the thing. If we can button ourselves up a little bit more in our boxes and our approaches, we're getting a little bit sloppy on things we didn't historically do that, not as an overall group, but just a couple flaws here and there. We need to clean ourselves up and kind of stay focused. Thank you though. You guys are working hard and we appreciate it. And I know it's a new model and a new style. But these types of things, you guys have historically done really well. You can do that.
Hey guys, before you shut down everything, just do me a favor, because could you just right now send Jess an email and just say that you're here? Because how many people are in the AIM program? 70, and how many